tax freight train is bearing down on your retirement. To protect yourself, you'll have to harness the power of zero.
Hi there, this is David McKnight. Welcome to the Power of Zero show. This is our 101st consecutive episode. Grateful that you're with us for yet another week. I am the best-selling author of The Power of Zero, Look Before You Lerp, The Volatility Shield, and as by now, November 17th coming, is the Tax-Free Income for Life. Excited for you to see that, of course. If you buy it now on Amazon, you'll notice that on Amazon, it's currently selling at $20, but many of you don't know that Amazon has a special feature that if they lower the price between now and when the book launches on November 17th, they will refund to your credit card the difference between what you paid now and what the ultimate price was. So you don't have to worry about buyer's remorse in terms of, should I wait until the price gets lower? If you buy now, you can go to my website at davidmcknight.com and enter your receipt and click redeem my free chapter, and you can download chapter 1 immediately so you can get a taste for what's to come. If you'd like to follow me on Twitter, please do so at McKnight & Co. That's at McKnight & Co. And if you are looking for someone to help you navigate all the pitfalls that stand between you and the 0% tax bracket, head over to davidmcknight.com and click on the strategy session button. We'll find an advisor in your neck of the woods that can help you, that's experienced, qualified, and vetted, that can help you navigate all of that. And if you are a financial advisor looking to transition your practice to a Power of Zero practice, please do at powerofzero.com. All right. That all said, today we are going to talk about some of the changes to the tax code that could happen should Donald Trump win a second term. Now, a lot of the pundits, the last I heard, it was a 77% likelihood that Joe Biden was going to win. But if you recall, at the same point in the last election, that Donald Trump faced just as steep odds at winning the White House. So I don't put a lot of stock into what the pundits are saying at this point in the game. As we all know, the race tightens up quite a bit as we approach election day. So we've talked quite a bit about what's going to happen potentially if Joe Biden wins. Let's talk a little bit about what could happen if Donald Trump wins. Now, Donald Trump has not laid out a second term tax proposal in the same way that Joe Biden has laid out his tax plan. But all of the things that we're going to talk about today are things that he has touched upon, referenced, commented on over the course of the last year or so. So let's take it right from the top. One of the things that we know that Donald Trump has already undertaken is he unilaterally implemented a payroll tax deferral. And this is basically an answer to the financial repercussions of COVID-19. Basically, we know that you pay payroll tax on of 12.4% up to $132,900 of your salary. So if you make $1 million, $132,900 of that is going to be taxed at 12.4%, and that goes into the Social Security kitty. He has currently and unilaterally stated that is deferred. Now, deferred means that sometime in 2021, you're going to have to pay that back. What he's hoping for is he's actually hoping for a holiday. And a holiday means that you don't have to pay it. Not only do you not have to pay it, but you don't have to pay it back. So he's hoping to all the money that you should have been paying along the way, he's hoping to put you in a position where you don't have to pay that back in 2021. The current plan is that you will have to pay it back. He's hoping to just waive that altogether. And then there has been some whisperings that he wants to eliminate the payroll tax altogether, which of course would be a disaster for Social Security and Medicare because they're already underfunded as it is and skating on extremely thin ice and would spiral into a deeper and deeper hole. Unless you subscribe to modern monetary theory, which simply posits that there is an infinity bucket, and that infinity bucket is the government's ability to print money, and we can just print our way out of all of these problems, then we should probably not permanently suspend the payroll tax. So that's the first one. Those are his thoughts and musings on what could happen with the payroll tax. The second thing that he would hope to do is to take a look at modifying capital gains taxes and or index those capital gains to inflation. Let me tell you what all of that means. So as of right now, we know that if you are married filing jointly, you don't pay any capital gains, long-term capital gains tax if you make less than $80,000 of income, of taxable income. From $80,000 up to $496,600, you pay 15%. And if you're above $496,600, you pay 20%. Donald Trump has proposed eliminating that upper bracket. In other words, you make more than $80,000, it's just a flat 15%, all the way up to infinity. And the idea there would be that would spur some economic activity because the cost of doing business, or at least paying tax on economic growth, would be minimized. What he's also proposed, and this is interesting, I've never heard this floated before by either a presidential candidate or Senate, candidate for the Senate or House. He has proposed that you index long-term capital gains to inflation. Let me give you a practical example of how that might work. So let's say you bought $2,000 worth of Coca-Cola stock this year. 3 years from now, you sell it at $4,000. And let's say that inflation, for whatever reason, increased by 25% over those 4 years. That means that your cost basis, which was $2,000 when you bought that Coca-Cola stock, when indexed for inflation over that 3-year period, assuming it was 25%, just to make our numbers easy, that means that your basis has been indexed to keep up with inflation. So your basis is now $2,500. Your basis is now $2,500. You sell that Coca-Cola stock for $4,000. Instead of paying capital gains tax on the $2,000 gain, you would now only pay capital gains tax on $1,500. Okay, so that's an interesting proposal. And should Donald Trump get elected, that would certainly, I would think, have some positive impact on economic activity and promoting more investment for businesses. The third thing that Donald Trump is looking at, and these first three I'm going to spend a lot of time on, or a fair amount of time. The last two aren't quite as relevant to our Power of Zero paradigm, but I'll touch on them briefly. The third one is a reduction in taxes on middle class. We know that his hallmark tax legislation was the Tax Cut and Jobs Act of 2017, which brought all of those tax brackets down. We now are looking at 10, 12, 22, 24, 32, 35, and 37. When those rates expire in 2026, the 10 stays at 10, the 12 becomes 15, the 22 becomes 25, the 24 becomes 28. Those are really the tax brackets that affect most Americans, and that's the change that would come about. What Donald Trump is looking to do is to specifically target middle Americans when it comes to tax cuts. So we're talking a 10% tax cut for middle income Americans. He has not gone into a lot of detail on when this would take place, precisely which brackets would receive the most cuts, but he has expressed a desire not to necessarily bring about tax cuts for the wealthiest Americans, unless it's by way of a capital gains tax cut, but specifically by middle income Americans. And really, we should understand by now that middle income Americans really is anybody who's making less than $400,000. If your household income is less than $400,000, that qualifies you as middle income America, which for people who are looking to make conversions from IRAs to Roth IRAs or doing LIRP conversions, what have you, this could be a pretty big deal if he were to cut that by 10%. Now, that doesn't mean that if you're currently at a 22% tax bracket that you're going to go down to 12. That's not how that works. That's taking 10% of 22, which is 2.22, subtracting that from 22, and that gets you just under 20. So a 10% of the total tax burden is what he's referring to. So that could be interesting in terms of if he could do that temporarily. Now, remember, he does not have and is not likely to have control of the House. He could retain control of the Senate, not likely to have control of this. So anything that he does is not going to be permanent. It's not going to be a permanent tax cut. You need the House, you need the Senate, and you need the presidency to make a permanent tax cut. The fourth thing that he's looking to do is he's looking to create some tax credit and some expensing credits for American businesses. He wants to encourage people to buy American, and so he's going to try to make American companies more competitive, particularly in the pharmaceutical and robotics industries. They're allowed to take 100% expense deductions on certain assets. I'm not going to get too much into that. And then he's also going to expand opportunity zones, which were created under the Tax Cut and Jobs Act. And basically what happens is an opportunity zone is designed to spur on investment in undercapitalized communities by giving enhanced capital gains benefits to individuals and corporations who invest in those communities. We have some of those actually in Puerto Rico, incidentally. So those are really the 5 things. Now, keep in mind, once again, Donald Trump has not committed these to paper. He's not created a formalized tax plan. He has simply said over in idle commentary or in speeches, or he is rumored to have said by advisors, these 5 things. Number 1, he wants to either create a payroll tax holiday or permanently repeal the payroll tax, which obviously, based on all the things that we've talked about in our podcasts up to this point, would be incredibly problematic for our country. The second thing he's looking to do is he's looking to eliminate the 20% capital gains tax rate so that anyone who's making above and beyond $80,000 of taxable income would only be paying at the 15%. And then he's looking to index your capital gains, your basis for capital gains purposes. He's looking to index that to inflation, which could certainly have an impact on you paying less capital gains tax. Third, he's looking to reduce taxes on the middle class, and we define middle class as anybody making less than $400,000. So really, that's the 22 and 24% tax brackets in terms of the sweet spot for our type of planning. If you can carve another 10% off of what the Tax Cut and Jobs Act already carved off, now all of a sudden we really are looking at a sweet spot that would come crashing shut come 2026. And then we made mention of the tax credits and expensing credits for American corporations, incentivizing them to do more business stateside, as well as expanding opportunity zones. So hopefully when we know who our next president's going to be, we'll be able to give a little bit more clarity on what to expect over the course of the next 4 years, whether it's Donald Trump and tinkering around the edges of some of the tax cuts he's already put into place, or the much more aggressive tax cuts that Joe Biden has really enshrined in his formal tax plan that he has on his website. All right, that's it for today, folks. We will look forward to chatting with you same time next week. Once again, if you're looking for an advisor who can shepherd you down the road to the 0% tax bracket, head on over to davidmcknight.com. We'll hook you up with someone who's been trained, vetted, and qualified. And if you are an advisor looking to transition your practice to a Power of Zero style practice, head over to powerzero.com. We'd be happy to chat with you. Talk to you same time next week.